The information provided in this video is for general informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.
Welcome back. If you are tuning in, it is the week of January 5th, 2026. In the financial world, the first full trading week of the year is often viewed through the lens of the January effect. This is a hypothesis suggesting that stock market performance in January can predict the trajectory for the rest of the year. Whether or not that holds true statistically, one thing is certain: volatility has returned to the markets to kick off 2026. This week, investors are navigating a convergence of three distinct drivers. First, the technology sector is centered on Las Vegas for CES, where the focus has shifted from consumer gadgets to the underlying infrastructure of artificial intelligence. Second, we have emerging geopolitical developments in Venezuela that are influencing energy futures. And third, we have critical data coming from the automotive sector and the labor market that could reshape Federal Reserve expectations. In this video, we will analyze the 5 key stories moving the markets this week. We will look at the bull and bear cases for the semiconductor giants, analyze the latest delivery numbers from the EV sector, and break down what Friday's jobs report means for interest rate policy. Let's examine the data. We begin with the technology sector. The Consumer Electronics Show, or CES, officially kicks off this week. While this event covers everything from smart homes to automotive tech, the market's attention is fixed on the semiconductor industry. The focal point is Nvidia, ticker symbol NVDA. CEO Jensen Huang is scheduled to deliver a keynote address on Monday, January 5th, at 1 p.m. Pacific Time. The bull case. Analysts are expecting details regarding the Rubin chip architecture. The bullish argument is that demand for data center upgrades remains inelastic, meaning major tech companies will continue to spend regardless of short-term economic conditions. If Nvidia confirms a concrete timeline for 2026 deliveries utilizing TSMC's 3nm node, it could reinforce the narrative of their technological moat. The bear case, however, valuations remain a point of caution. Nvidia is trading at a significant premium relative to its historical averages. Skeptics argue that if the company focuses heavily on software or long-term vision without providing immediate supply chain updates, the stock could see a sell the news reaction. The market is looking for execution, not just vision. Later on Monday at 6:30 p.m. Pacific, AMD's Lisa Su will present. The context: AMD, ticker symbol AMD, has been positioning itself as the leader in the AI PC market. The thesis here is a hardware refresh cycle. Industry projections suggest that consumers and enterprises may upgrade their laptops in 2026 to run AI models locally on device, rather than in the cloud. Investors will be listening for partnerships with major OEMs like HP and Dell. Finally, Intel, ticker symbol INTC, is launching its Panther Lake processors. Intel shares have underperformed their peers in recent years. The critical metric to watch here is power efficiency. If independent benchmarks show that Intel has closed the gap with its competitors, some value-oriented investors may view the stock as undervalued. Conversely, if the chips fail to meet performance targets, it may reinforce the market share loss narrative. Moving to the automotive sector, we have significant data releases concerning electric vehicle demand. Rivian, ticker symbol RIVN, released its production and delivery figures for the full year of 2025 over the weekend. The company reported 42,247 vehicles delivered. The analysis: this figure came in below the general consensus of 42,500. While the margin of the miss is relatively small, less than 1%, the market reaction often depends on the broader trend. This follows reports that Tesla, ticker symbol TSLA, saw sales decline by 9% year-over-year in 2025. The macro environment: there are two opposing views on this data. The pessimistic view suggests that the EV market is hitting a saturation point, exacerbated by the expiration of U.S. federal tax credits late last year. Investors holding this view are concerned about cash burn rates and inventory buildup. The optimistic view, however, notes that interest rates are expected to stabilize or fall in 2026. Lower financing costs could reignite demand for high-ticket items like vehicles. For Rivian specifically, attention now turns to their earnings call on February 12th, where they are expected to update guidance on the R2 platform. Investors will be looking for confirmation that the lower-cost model remains on schedule to launch, as this is central to the company's growth valuation. Next, we look at the energy markets, which are reacting to geopolitical developments in South America. Reports over the weekend indicate increased military activity involving the United States and Venezuela. While the situation remains fluid, the stated objective appears to be the stabilization of energy infrastructure. This has introduced a risk premium into the price of oil futures. Understanding the trade, oil markets are driven by supply and demand elasticity. In the short term, uncertainty regarding conflict tends to drive prices up. Traders fear supply disruptions, leading to a spike in West Texas Intermediate and Brent crude prices. This generally correlates with a rise in energy stocks such as ExxonMobil, ticker XWM, and Chevron, ticker CVX. The long-term supply outlook. However, the medium to long-term outlook presents a different scenario. If the intervention leads to a stabilization of the region and the removal of sanctions, Venezuela possesses the largest proven oil reserves in the world. A return of Venezuelan supply to the global market would theoretically increase supply, placing downward pressure on oil prices. Investors in the energy sector should monitor State Department press briefings this week. The clarity, or lack thereof, regarding the duration of these operations will likely be the primary driver of volatility in the energy sector for the immediate future. Turning to digital assets, this week marks the 2-year anniversary of the approval of spot Bitcoin ETFs in the United States. Data from the past 2 years shows a shift in market structure. According to recent flow reports, institutional products, specifically those managed by BlackRock and Fidelity, now account for a significant portion of daily trading volume. The sovereign thesis. Market analysts are currently debating the sovereign thesis for 2026. This is the theory that sovereign wealth funds and nation-states may begin allocating a percentage of their reserves to digital assets. What to watch? The correlation between Bitcoin and the Nasdaq 100 is a key metric this week. Historically, crypto assets have traded in tandem with high-growth tech stocks. However, proponents of the asset class look for decoupling. Periods where tech stocks may fall due to macroeconomic fears, but digital assets rise or hold steady, behaving more like a hedge or digital gold. With the geopolitical uncertainty mentioned in the previous segment, traders will be observing if capital flows into Bitcoin as a risk-off asset or out of Bitcoin alongside other speculative assets. The direction of these flows could indicate how institutional investors are currently categorizing the asset class. Okay, bringing it all home. We have the tech, the E versus the oil, and the crypto. But none of it matters if the bond market breaks on Friday. Friday, January 9th, 8:30 a.m. Eastern. The jobs report. Consensus is for 55,000 jobs added. That is a low number. The unemployment rate is expected to tick down to 4.5%. Here is the trap. The Fed meets in 3 weeks. They want to cut rates. But if this jobs number comes in hot, say over 100,000, yields are going to spike. The 10-year Treasury is sitting right at 4.2%. If it breaks 4.3%, algos will sell tech stocks automatically. So here is my plan for the week. 1. I am watching the Nvidia keynote on Monday. If the stock pops, I am taking some profits. 2. I am avoiding Rivian and Tesla until the dust settles. 3. On Friday morning, I am sitting cash until 10 a.m. Do not gamble on the jobs report headline. This is a week for snipers, not shotgun blasts. Be precise. If you want to see exactly how I am positioning my portfolio for the Venezuela news, check out the link in the description. Thanks for watching, stay disciplined, and I will see you in the next one. To summarize, the week of January 5th brings high-impact events across multiple sectors. We have the technical roadmap for AI being laid out in Las Vegas, a test of consumer strength in the automotive numbers, geopolitical supply risks in energy, and a pivotal labor market report to close the week. As always, successful portfolio management relies on analyzing the data as it comes in, rather than predicting the outcome. We will be covering the breakdown of the Nvidia keynote and the jobs report numbers as they are released. Thank you for watching, like and subscribe, and we will see you in the next update.